Welcome to the deep dive. Our mission, well, it's pretty straightforward. We take the sources, you send us articles, research notes, whatever you've got, and basically cut through it all to find what really matters. Think of it as your shortcut to getting informed based only on the material provided.
Exactly. We're here to guide you through this specific information. We'll point out the key things, try to explain what the source seems to be emphasizing, and, help you understand the picture it paints, just based on this material.
And today, we're really digging into the Indian stock market, specifically looking at a newsletter from Volatility Coaches of India. It's dated May 25th, 2025, and it seems packed with info.
Oh, definitely. It covers quite a bit. We've got current market parameters, things like valuation, momentum. Then there are observations on, market sentiment, where they think the focus should be.
Right, and there's also some historical trend stuff, future return projections based on certain models, and even detailed sector data.
Yeah, a whole snapshot.
So our goal here is simple. Walk you through this, highlight what seems most interesting, what the source itself seems to think is important right now. Okay, where do we start? Let's unpack what this newsletter actually shows us first.
Right. So it kicks off with a snapshot of key parameters. They call them RVCC parameters. And it compares May 25th, 2025 against the week before, May 18th. RVCC, I guess, is their specific framework or maybe the metrics they track consistently.
Okay, looking at the valuation side by side, price to earnings, the PE ratio, it's flat. 22.4 both weeks.
And price to book, PB, also the same, 3.7. So yeah, basic valuation metrics according to the snapshot, we're holding steady week on week.
Okay. Then there's market cap to GDP. That's another sort of big picture valuation measure that dipped slightly.
Just a little, yeah, from 123.72% down to 122.8%. So a minor shift down there.
Now, here's where it gets interesting, I think. The RSI, Relative Strength Index people, often use that for momentum.
Right, it's a common momentum indicator.
That jumped quite a bit. It was around 55, maybe 56 the week before, and it shot up to 65. That seems like a pretty significant move up in momentum, wouldn't you say?
It definitely signals a shift, yeah, a notable increase. And alongside that, you've got the FII net open interest change, that's foreign institutional investors.
The big overseas funds.
Exactly. Their activity showed a really substantial positive inflow, over 8,000 crore increase. So that suggests, strong buying from them during that week.
But wait, the Nifty Y index itself, it actually closed lower. 244,853 compared to 250.20 the week before.
It did. The main index dipped, but interestingly, its 13-day exponential moving average, the 13 EMA, which is a short-term trend line, that actually increased.
Increased. From what to what?
Let's see, from 245.35 up to 246.64. So the Nifty itself, despite closing slightly lower for the week, was still trading above this rising short-term average.
So, okay, let's piece this together. You've got stable PE/PB, slightly lower market cap to GDP, but then, bang, higher momentum on the RSI, strong FII buying, and the index holding above its rising short-term average, even with a slight price dip.
Exactly. It's not a simple picture, is it? Not just up or down, based purely on these numbers they provide. It's a kind of a mixed bag, suggesting some underlying churn or shifting dynamics. That's what these metrics seem to show.
Right. Not uniform at all. Okay, so moving from that immediate snapshot, the newsletter then looks longer term, discussing expected future returns, using something called the Buffett indicator.
Yeah, they shift gears a bit there. This section tries to forecast the potential annual return for the Indian market over the coming years, using their specific model, which they link to that name.
And what's the number they land on?
The source projects a 6.3% annual return.
6.3%, okay. And how do they arrive at that? Is it broken down?
Yes, they break it down into three components in their analysis. So they attribute 6.86% to economic growth, that's in local currency terms. Then 1.53% comes from dividend yield.
Okay, growth and dividends.
Yeah.
But that adds up to more than 6.3%.
Right, because there's a third piece, a negative contribution. They list negative 2.1% coming from something they call valuation reverse to the mean.
Valuation reverse to the mean. Okay, in simple terms, what does that usually imply, based on how they're using it here?
Well, it suggests that the source believes current market valuations, whatever metrics they're using for that, are maybe a bit high compared to some historical average, and they expect those valuations to compress or come down slightly over the projection period.
So it acts as a drag, a small drag on the total return you'd otherwise get from growth and dividends.
Pretty much, yeah. The idea that valuations might normalize downwards a bit. Now, they also mention a modified model.
Ah, okay. Does that change the picture much?
Interestingly, no, not really. The contributions from economic growth, that 6.86%, and dividend yield, 1.53%, they stay exactly the same in this modified version.
So what changes?
The only thing that shifts, and only very slightly, is that valuation reversal number. It becomes negative 2.11% instead of negative 2.1%.
Which means the final number, the expected annual return under this modified model is?
Also 6.3%.
Huh. So consistent then.
Yeah, that seems to be the key takeaway here. The source is pretty consistent with its 6.3% annual return projection for the Indian market, over the next few years. Doesn't matter which of their two models they use here. It's mainly driven by growth and dividends, with just a small expected headwind from valuations coming off a bit.
Okay, interesting. Now, there's a section header here that's a bit confusing. It says U.S. market valuation, notes and observations.
Yeah.
But when you actually read it, it seems to be talking about India, right? Like sentiment notes for the Indian market.
That's exactly right. It looks like maybe just a slightly misplaced heading. The content itself seems to be their strategic takeaways or advice for the Indian market based on their overall view.
Okay, so what are these observations then? Under positive sentiments, what do they suggest?
They recommend starting new SIPs, that's systematic investment plans, and STPs, systematic transfer plans, the regular investment methods.
The common ways to invest gradually.
And they explicitly say this period, or this zone, as they call it, is a time to accumulate.
Accumulate. Okay. Anything else?
Yeah. They also suggest that investing in business cycle funds can be a good idea now, 2-3 years view. So a medium-term horizon there.
And do they specify where to focus within funds?
They do. Their current focus areas, according to this note, are large cap funds and hybrid funds.
Large caps and hybrids. And sectors. Any specific sectors mentioned?
Yes, they narrowed down the current sector focus to banking, finance, and defense.
Okay. So, yeah, despite the odd heading, this section gives pretty clear recommendations. How to invest accumulate via SIP, SSTPS. What kind of funds, large cap, hybrid, maybe business cycle, and where banking, finance, defense. It's just a fairly positive long-term stance, even if some of the short-term signals we saw were a bit mixed.
It is interesting, isn't it, seeing that time to accumulate sentiment right alongside that projected 6.3% return? It implies the source thinks either that return is attractive enough or the current market levels are good for entry, even factoring in that potential valuation headwind they mentioned.
Good point. It gives context to their recommendations. Now, speaking of context, the newsletter also looks back, right?
Yeah.
It summarizes some historical nifty trend analysis they do.
Yeah, this part shows how they track market direction over time. They use categories like negative, positive, neutral, trend. The main thing to get from this is just how dynamic their signals are. The summary shows these labels flipping back and forth quite a bit between 2022 and 2025.
Right, I'm scanning through it. You see notes like negative early 2022, then turns positive, then back to negative or neutral, then very negative in September 23, positive again in October 23. Then advice to book profit or shift to debt in November 23, confirms negative in Dextrin 23 in Jan 24. It really looks like their indicator caught a lot of will chop.
Exactly. It really underscores that their trend signal isn't something static. It moves around.
Right.
If we look specifically at the more recent movements mentioned in the summary.
Okay, yeah, what's the recent picture?
Well, the source noted a negative trend from 20th December 2024 continues and apparently saw no reversal for a while after that.
Okay, so negative coming into 2025.
Then they mark a trend reversal on 21st March 2025, so it flipped positive there.
But not for long.
Apparently not. Just a couple of weeks later, the note for April 4th says Nifty closed negative and the trend bearish in short term.
A quick flip back down.
But then, by April 18th, 2025, the source notes the trend turned positive again. And this positive trend, it says, continued till date, meaning up to the date of this May 25th report.
So let me recap the recent bit. Negative late 24 into 25, positive flip in late March 25, short-term bearish signal early April, then back to positive trend from mid-April onwards, lasting up to the report date.
That's the sequence they lay out. It definitely highlights the sensitivity of whatever model they're using for this trend analysis, especially to recent market moves.
Okay. Now let's circle back for a second. Remember those RVCC parameters we started with? The source included a specific conclusion there about smaller companies.
Yes, good point. Based on their RVCC analysis, they made a specific call out for mid and small caps.
What did it say?
It states that the Nifty Small Cap 100 remains positive.
Okay, small caps positive.
And similarly, the Nifty Mid Cap 150 also remains positive.
Right. So that's actually a really key distinction the source is making here, isn't it? Despite maybe more mixed signals for the main Nifty index or the dynamic trend flips we just talked about, their specific RVCC analysis concluded that mid and small caps were still showing positive signs as of the report date.
Yeah, it flags a potential difference in how the source views the large cap dominated Nifty versus the outlook for smaller companies at that specific moment.
Interesting divergence. Okay, finally, the newsletter wraps up with a big table, right? Sectorial index data for May 25th itself. This gives us a really granular look.
It does. It shows how various market segments performed on that specific day, May 25th, and lists their PE, PB, and dividend yields at that point, according to this data source.
And looking down the percent change column for that day.
Hmm.
Wow. One thing that really jumps out is that almost everything is red. A lot of negative changes listed for May 25th.
That's a key observation, yeah. Nifty 100 down 0.92% on the day. Nifty Midcap 100 down 0.64%. Even the Nifty Smallcap 100.
Which they just said remains positive in trend.
Right, but on this specific day, May 25th, it was down 0.8% according to this table.
Yeah, most of the indices listed show negative percentage changes for that single day.
The table also gives those valuation snapshots, PE, PB, dividend yields.
And you see quite a range there, like Nifty 100 PE around 22.3, but Nifty Midcap 50 much higher at 38.5, Nifty Smallcap 100 around 31. Big differences in PE ratios across segments. Same for PB. And the dividend yields look pretty low across the board. Nifty Y100 at 1.15%, Midcap 100 just 0.82%. Not huge yields generally.
No, not particularly high based on this data. And the India VIX, the volatility index, is also in this table. It closed at 17.28 that day, with a very small change.
So this sector table really gives you that immediate day of snapshot. May 25th itself saw widespread declines across these indices, which contrasts a bit with the weekly parameter changes we saw earlier, and definitely with the source's overall accumulate sentiment.
It does. It highlights the difference between a single day's noise and the broader trends or outlooks the source is trying to convey elsewhere.
Okay, let's try to pull all these threads together then. We started with that RVCC snapshot showing shifts like, rising RSI and VIX, stable PEPB, good FII flow, but Nifty slightly down while staying above its 13 EMA.
Then we looked at their long-term view, the Buffett indicator models, consistently landing on that 6.3% expected annual return, driven mostly by growth in yield, but with that slight valuation headwind expected.
We covered the source's actual sentiment notes, time to accumulate, recommending SIP SSTPs, business cycle funds, focusing on large CAFI hybrid funds, and specifically banking, finance, and defense sectors.
We touched on their historical trend analysis, how dynamic it is, but noting the recent signal had flipped back to positive after mid-April 2025 and was holding as of the report.
And importantly, we saw that specific RVCC conclusion about mid and small caps remaining positive, even though the daily sector data for May 25th showed mostly negative moves across the board, including for those segments.
Yeah. So, taken together, this information gives you a pretty detailed picture of the market conditions and the outlook, as presented by this specific source, Volatility Coaches of India, on May 25th, 2025. It's a real mix of immediate data, forecasts, strategic advice, and trend following.
It really paints a fascinating, maybe slightly complex picture, doesn't it?
Yeah.
Makes you think about how to weigh different signals and timeframes.
Absolutely. You've got this quite strong sentiment from the source, time to accumulate, focus here, focus there, presumably linked to their longer-term 6.3% return expectation.
But then you have to square that with the short-term stuff presented in the same report, the uptick in volatility, the Nifty slight dip that week, and especially that table showing most indices down on the day the report came out.
Exactly. So it leaves you with a really interesting question to ponder. How does the source itself reconcile its strong conviction about accumulation and sector focus, likely tied to that long-term 6.3% view, with the short-term choppiness, the rising VIX, and the negative daily data points also included in their analysis? It really makes you think about balancing those long-term outlooks against the immediate market signals they're presenting. What's driving their ultimate recommendation?